On the other hand, as illustrated here, if the current ratio is negative and there is an increase of amount in the total current assets and total current liabilities, the new current ratio will increase. So in the illustration here, we have a current assets of 25,000 and the total current liabilities of 50,000. So when you say negative current ratio, it means that the current assets is less than the current liabilities. So when there is an increase of 10,000 on both sides, or in both the current assets and the current liabilities, now it becomes 35,000 in the assets and 60,000 on the liabilities. So the new current ratio now is 0.53:1. So it increases. Moving on to number 2, acid test ratio or quick ratio or liquidity ratio. So illustrating here the 2015 figures. So the formula here is quick assets, that is consists of cash plus trading securities plus receivables over current liabilities. So if you are wondering where did we get these figures, so please refer again to what I have given before this one, the illustration. So the cash of 106,000 and the trade and other receivables of 327,000, as well as the current liabilities here, the 390,508. So this is where we get these figures since we are referring to 2015. The result of this formula is 1.11:1, or that is 1.11%. So as to our task for the 2014, so these figures are from the cash and cash equivalents of 2014, the trade and other receivables of 2014, as well as the total current liabilities of 2014. So it is the figures that I have given you. The result is 1.13:1, or that is 1.13%. The quick ratio is a stricter test of liquidity. This could be interpreted that for every 1 peso liability, the firm has 1.11 of current assets to pay it. As you can see, real is not as liquid as we pictured it to be when the current ratio was used. As a general rule, the higher the quick ratio, the more liquid the firm is, and thus can pay its current maturing debts. Note that the inventories are ignored because of its nature being uncertain as to their saleability. So I have already mentioned that before. So another reason for their exclusion from the formula is its uncertainty as to when the item will be converted into cash. This is more so if the company is a manufacturing entity where the inventory will be raw materials to work in process to finished goods, eventually and converted to receivables, and eventually collected and converted into cash. Next is asset utilization liquidity analysis. So number 1, this is for accounts receivable and accounts receivable turnover. So in 2015, the formula here is net sales of 3,007,887 over average accounts receivable of 277,467 plus 327,611 over 2. So these number figures are taken from the illustration, the second illustration that I have given you here. The net sales here is 3,007,887 2015. This is where we get the net sales. And then for the average account receivable, we have here the 277,000, that is from 2014, and the 327,611 in 2015, because we are talking about the average accounts receivable. So the 2 years, the previous and the current year, are involved here. So as to the result, it is 9.94 times. Note that for the 2014 receivable turnover, you may use the ending inventory of 2014 as the average inventory. So now, in days sales and average receivables or average collection period in 2015, the formula here is days over receivable turnover. So that is 365 days since it represents a year, and then a receivable turnover of 9.94 times as what we have solved before. So the result is 36.7 days. This ratio is used to measure the liquidity of the firm's receivable. The result of 9.94 times could be interpreted to mean that the firm is able to collect all the receivables 9.94 times in a year. A high turnover rate means the receivables are collected in a short period of time. In real corporation's case, it is able to collect the average receivables every 37 days or approximately every month. This has great bearing on management since a high receivable turnover speeds up its conversion to cash, and thus management can use it further to enhance company operations and ultimately increase company profits. So stated here in the book, a high receivable turnover rate does not automatically mean good or efficient collection of the company. The high turnover rate could be caused by any of the following. First, price level changes. Second, changes in sales terms. Third, special sales promotions. Fourth, strikes and plant shutdown during the previous period. Fifth, higher cash sales. And lastly, the turnover was computed was when most receivables are collected. Number 2 for the inventory. This is inventory turnover ratio. So the inventory turnover rate pertains to the number of times the average inventory is sold, or that is finished goods and merchandise, or used raw materials, or process or work in process. The following formulas are adapted depending on the nature of the inventory being assessed. So the first formula adapted for the inventory turnover ratio is the raw materials inventory turnover. The formula here is raw materials used over average raw materials inventory. Next is the work in process inventory turnover. That is cost of goods manufactured over average work in process inventory. Next is finished goods inventory turnover. The formula is cost of goods sold over average finished goods inventory. Next is merchandise inventory turnover. That is cost of goods sold over average merchandise inventory. And then lastly, average inventory is equals to the beginning inventory plus ending inventory over 2. So for our example here, we will use the merchandise inventory for 2015. The formula is cost of goods sold over average inventory over 2, and then the result. So if you are wondering where would we get this number figures here, the 2 million and etc., please do refer from the illustration that I have given. Here, this is the cost of goods sold. It was given already, but actually it has a computation before you arrive in this amount. And then for the average inventory, so the 2 years will be involved here. The 2014 inventory as well as the 2015 inventory. So it is where we get the figures. So the result here is 6.98 times. So in computing for the 2014 inventory turnover, we should use the ending inventory of 2014. The inventory turnover indicates the company's efficiency in managing and disposing inventory. As a general rule, the higher the turnover rate, the better. However, this is not always the case because a high turnover rate may also indicate that the firm is underinvesting in their inventory or suffering lost orders. It may also mean inventory shortages. On the other hand, a low inventory turnover rate may indicate that the firm has too much inventory in their warehouse or is harboring too much obsolete inventory. Low inventory turnover may also mean that the company has slow-moving or worse, inferior inventory stock. Lastly, it may simply indicate slow and low sales of the firm for the period. As the analyst, you must account for the result of the turnover when reporting it to management. So for purposes of providing an interpretation for real corporation, the result has a relatively slight unfavorable inventory turnover.